Imagine two people making the same $150,000 a year. One gets paid by working, the other gets paid by owning. They may have similar houses, similar cars, and even similar lifestyles. But there is one enormous difference. If the first person stops working, the money stops. If the second person stops working, the money may keep arriving. That is the part of wealth most people never see. We tend to think rich people become rich because they earn enormous salaries. Sometimes they do. But the deeper secret is what they do with the money after they earn it. They turn income into assets, and those assets can produce more income. A rental property can collect rent. A stock can pay dividends. A business can generate profits. A bond can pay interest. A portfolio can appreciate while its owner is asleep. This creates a strange financial loop. You work for money. Then you use money to buy something that works for you. And eventually, if the system becomes large enough, your labor becomes less important to your income. That is what separates a high earner from a wealthy person. A high earner has a large income. A wealthy person has ownership, and ownership changes everything. So how does this actually work? Start with something simple: cash flow. Cash flow is just money coming in minus money going out. If you earn $5,000 a month and spend $4,000, you have $1,000 left. Most people use that extra money to buy things. Wealth builders try to use it to buy assets. That distinction sounds small. It isn't. Suppose you spend your extra $1,000 on a luxury purchase. You enjoy it once, but after that, the money is gone. Now imagine putting that $1,000 into an asset that produces income. The asset may generate money next month, and the month after that, and the month after that. The money is no longer simply being consumed. It has been converted into a productive machine. This is the basic logic behind compounding. Your money produces a return. That return stays invested. Then the larger amount produces another return. Over time, the growth starts producing growth of its own. This is why time matters so much. Consider a hypothetical investor who puts $10,000 into an investment earning an average 8% annually and leaves it untouched. After 1 year, it becomes roughly $10,800. The next year's return isn't calculated on the original $10,000. It is calculated on the larger amount. Eventually, the curve stops looking like a straight line. It starts bending upward. But there is another layer. The wealthiest people often don't just own financial assets. They own businesses. And businesses can create cash flow at a much larger scale. Take a company like Microsoft. Microsoft doesn't simply hold money in a bank account. It owns software, cloud infrastructure, intellectual property, customer relationships, and other assets capable of generating enormous revenues. The owners of the company don't personally perform every transaction. The system does the work. Employees work. Customers pay. The company collects revenue. Expenses are paid. What remains can become profit, and shareholders participate in that economic value because they own part of the machine. That's the critical idea. The rich don't necessarily work harder for every dollar. They build systems that can produce dollars without requiring their personal labor for each one. Now we can follow the money. Imagine you own a small apartment building. Tenants pay rent every month. That rent becomes revenue. From it, you pay maintenance, insurance, taxes, management costs, and possibly a mortgage. Whatever remains is cash flow. You didn't need to personally work an extra 8 hours for every dollar. The property generated the revenue. This is why real estate has historically been so attractive to wealthy investors. But real estate is only one example. Consider stocks. When you buy a share of a profitable company, you are buying a tiny ownership claim on that business. The company can reinvest its profits. It can buy competitors. It can build factories. It can develop new technology. It can repurchase shares. And sometimes it distributes part of its profits directly to shareholders through dividends. Now consider bonds. When you buy a bond, you are essentially lending money to an institution or government. In return, you receive interest according to the terms of the bond. Again, the mechanism is different, but the underlying principle is similar. Capital produces a return. And this is where the system becomes especially interesting. The wealthy don't necessarily need to sell their assets to live from them. They can sometimes use the assets themselves as financial leverage. A person with substantial investments may be able to borrow against those assets rather than selling them. Why would that matter? Because selling an appreciated asset can create a taxable gain. Borrowing is different. A loan is generally not treated as income. Of course, debt comes with interest and risk. If asset values collapse or cash flow disappears, leverage can become dangerous very quickly. But for people with enormous asset bases, borrowing can become another tool for managing liquidity. This is one reason the financial world can look completely different from the perspective of someone with $10,000 compared with someone controlling $10 million. The person with $10,000 usually needs cash. The person with $10 million may have choices. They can sell, they can borrow, they can refinance, they can reinvest, they can wait, and having options is itself a form of financial power. But here is where the story gets more complicated, because the system doesn't reward everyone equally. If you have little capital, most of your income usually comes from labor. You sell your time. 1 hour of work produces a certain amount of income. There is a ceiling. You only have 24 hours in a day. But an asset doesn't have that limitation. A company can sell to millions of customers simultaneously. A software product can be purchased thousands of times without its creator personally delivering each copy. A rental property can collect rent every month. A stock portfolio can generate returns across hundreds of companies. Capital can scale. Human time cannot scale nearly as easily. That creates a powerful feedback loop. More income can create more savings. More savings can create more assets. More assets can create more cash flow. More cash flow can buy more assets. And more assets can create even more cash flow. The cycle accelerates. This is why the first $100,000 can feel incredibly difficult, while the next million can become mathematically easier. Not easy, but different. The biggest advantage isn't necessarily intelligence. It is the ability to keep capital invested for long periods. And this is also where inequality enters the picture. People with substantial wealth can survive market downturns without being forced to sell. Someone living paycheck to paycheck may have no choice. A medical bill arrives. The car breaks down. Rent increases. A job disappears. The investment account gets sold. The wealthy investor may be able to wait for the market to recover. The person with no financial cushion cannot. So wealth isn't simply about how much money you have. It is also about how much time your money gives you. Time to wait, time to recover, time to invest, time to take risks, time to say no, and perhaps most importantly, time to let compounding work. This brings us to the biggest misconception about wealth. People often look at the mansion, the private jet, the expensive watch. But those are the visible outputs. The real engine is usually somewhere behind the curtain. Ownership, cash flow, compounding, leverage, and time. The wealthy person's greatest asset may not be a particular stock or property. It may be the machine they have built around their capital. But there is an important warning here. Cash flow is not free money. Every asset carries risk. A rental property can sit empty. A company can lose customers. A stock can crash. A bond issuer can default. Interest rates can change. Debt can magnify losses just as easily as it magnifies gains. And an investment that looks like a cash flow machine can sometimes be a financial trap. That's why the real lesson isn't simply buy assets. It's more precise than that. Understand what produces the cash. Understand what can destroy it. Understand who receives the money. And understand who carries the risk. Because there is a fundamental difference between looking rich and controlling a productive asset. One consumes money, the other can generate it. And that may be the most important financial distinction of all. The modern economy is full of people exchanging time for money, but sitting quietly behind them is another system. A system where money buys ownership. Ownership generates cash flow. Cash flow buys more ownership. And ownership creates even more cash flow. Once that machine becomes large enough, something remarkable happens. The person no longer needs to chase every dollar. The dollars begin chasing the assets. And that is the real secret behind the phrase, making money while you sleep. It's not magic. It's not a shortcut. And it certainly isn't guaranteed. It is the result of owning things that remain productive after you stop working. Which leaves us with a more uncomfortable question. If ownership is what ultimately creates financial freedom, who owns the machines that generate the world's cash flow, and who is still working for them?